Everyone's got a plan until they get punched in the face. And that saying was made famous by Mike Tyson back in his heyday. And that's kind of what he said when reporters would ask him, "Hey, you're going up against this famous boxer. What are you going to do? They've been studying you and they got a plan." And he would say, "Hey, as soon as I punch them in the face, their plan is pretty much out the window." And I thought it was a good analogy here with the markets. The last few years have been pretty, I'm not going to say easy because trading's not easy, but the market's been basically going one way. So if you were a trend follower, you probably did pretty well. But all that changed in February of 2018. I'm doing this video late February 2018. And really the market, I think, has changed. The volatility is up. You can no longer just short volatility. You can no longer just buy the dip and go long. I think that we're headed into a kind of a larger range bound market. And so I put together this presentation and some stats, things from another correction from a few years ago. And we're going to kind of talk about that. So let's just go ahead and get into it. This plan, or it's really kind of a guideline, we're going to talk about specific entry criteria for trading both bear and call spreads. And it's relatively simple. And it is based on some market expectations. And again, we had this huge pullback into the 200-day moving average. We're no longer in the ultra low volatility environment, although it has calmed down a little bit. But really, whatever plan that you go with when you're trading, you got to understand that as the market changes, sometimes you got to change your plan. When it comes to credit spreads, that's what we're going to do here. So, as the year unfolds, we'll see if these expectations play out. But be sure to subscribe to the channel, and we'll obviously update with changes to our plan, that kind of thing. And if you want a copy of this presentation, we're going to have the rules and some of the charts in here. Check the description of this video, and I'll email it over to you. And that way, you can keep a copy if you want to, have the plan to take with you. So, let's talk about the market expectations now. So again, I'm doing this video the end of February 2018. And in the beginning of 2018, we had a 10% correction. It was one of the fastest pullbacks, I think, ever or something. I don't forget what the exact stat is. But when I go back in time, and at least in this bull market, when we had a correction like this, it reminds me of October, kind of late 2014, where we had a similar correction where the market dipped below the 200-day SMA, or the simple moving average. And then for the next 2 years, the market really just traded in a large range. And then ultimately it moved higher. But just think about that, 2 years of a large range. And we're going to look at the chart here in a second. But I want to add a couple other things that are starting to happen. We have a new Fed chief, who's basically signaling that rates will be rising to combat inflation. This is not the same environment we had, in 2014 when we had that dip. And so again, I think that we're probably in for a large range. We could go lower, we could go higher. But I think the easy days of just buying the dip and making new highs are probably few and far between. And I'm looking to trade this market, at least from a credit spread perspective. And that's kind of what we're going to focus on, how to trade credit spreads. That's kind of what I'm focused on, at least for the short-term future, and we'll kind of see how that goes. So let's go ahead and take a quick look. I pulled this chart out. This is the SPY. This is just a daily chart. And real quick, this little yellow squiggly line is the 20-day moving average. You have this blue is the 50-day moving average, and the 200 is this kind of maroon color. And this is the correction that I'm talking about. This was October of 2014. And I want you to just think about this. So you can see the market was in a bull run. Yeah, we dipped below the 50, but we never actually hit the 200. Kind of came back up, consolidated, made new highs, pulled back, came back up, consolidated, and then we had the dip. Now, in this particular market, we actually ended up with a V bottom, making new highs. But then again, the next couple years, you really, when I say a large range, we didn't make the new high in the beginning here, but we did kind of make new highs, but the highs were smaller, a lot of consolidation. We had another huge, crash, dip, whatever you want to call that, chopped around, started to come back up, came back down. And so again, for the next couple years, you look at October or September of 2014, it's not that much different from late 2016. So there was a really big range, and that's kind of the market that I foresee us having. Now, again, I don't know if that's going to happen or not. We could have a dip and and just move higher, but essentially. We had this dip, and I'm looking for that range. So let's talk about trading the large range. I got a few just kind of general guidelines or things I want to kind of go through, and then we'll talk about the actual numbers. So typically when markets decline or sell off, the volatility increases, which typically cause the option prices to increase as well. So what we're going to use as a trigger point for an entry is a multi-day sell-off. And I like to look at 2 or 3 days, and we'll look at both because I got a spreadsheet that I can share with you guys. But we're going to look at multi-day sell-offs. That means selling off multi-days, more than one day in a row. And that's going to be sort of our entry. And that's going to be the entry for both bear call spreads and bull put spreads. Because again, when the market sells off, the option prices on both sides tend to increase a little bit. And that's going to help us get our fills, and it will help us, kind of a clear entry point, right? So the other two things we're going to use are the 20 simple moving average and the 200 simple moving average, to kind of, know which one you should do. Should you sell a bear call spread? Should you sell a bull put spread? It might not be what you think it's going to be, but it'll be interesting. So that's the criteria we're going to use to kind of put a trade on, and then we'll use some general, basic guidelines for exiting the trade, which we'll talk about later. But what I want to do now is I want to look at a spreadsheet that I had compiled here. And again, if you want to get a copy of the presentation or the spreadsheet, look at the description of this video. And in this spreadsheet, I've got 17 years of data all the way back from 2000 through 2017. It's looking at the closing price of the SPY. And we're going to segment off that time period and look at the results, or had you follow these guidelines, how that did during this time period. So let's go ahead and check out the spreadsheet. So it's a pretty simple spreadsheet, and you're able to manipulate the time frame. So again, the time frame we're going to look at is basically the end of October 2014. I'm going to update the dates here, and you'll start to see some of these numbers move around. And again, this spreadsheet has all the data in it. It's not looking outward, so you can, you could manipulate the spreadsheet without having to be online. Everything's inside the spreadsheet. And then we're going to go all the way through about the same time frame of 2016. So about a 2-year time frame. And it's going to look at the closing prices of the SPY. And so when we go back to, let's go back to the other chart real quick. And the general idea here is that we're going to sell bear call spreads at the top of the range, and we're going to sell bull put spreads at the bottom of the range, and really identifying what that means. What is the top of the range? And that's where the moving averages come in. And so what we're going to do first is look at, okay, for something to be overbought or near the top of the range, we're going to use the 20-day moving average as kind of the threshold. So if we're trading above the 20-day moving average, we're going to be looking to sell bear call spreads. So if I go back to the spreadsheet, I'm going to change my simple moving average to 20 days. And I want the close of the trigger, which we'll talk about in a second, to be above the moving average. So the close above the 20-day moving average. And the trigger point is how many days it's sold off in a row. So again, we can do this for 2, 3, 4, and 5 consecutive day declines. So we're going to say, okay, if we sold off 2 days in a row, and that's the wrong number there. If we sold off 2 days in a row, and that close, that second day in a row of a close, was above the 20-day moving average, where is the stock, or where's, in this case, the index, 30 days later? Well, 30 days later, it is down or below that level 55% of the time. In this case, there were 29 instances, and 13 times it was up and 16 times it was down. So it's a little bit better than 50-50. But when we're selling call spreads, we don't want to sell at the money. We want to sell slightly out of the money. So if I change the percent of the trigger point is the closing price of that day, I'm going to put it 3% out of the money, saying, okay, if I sold a call spread that's about 3% out of the money, 1.03 times that price, 30 days later, it's now going to be below that over 80% of the time. And that's where we get that little bit of an edge, that probability that, hey, this is a range-bound market when we're top of the range, and we're calling that above the 20-day moving average. That if we sold something 3% out of the money, and sometimes even 4% out of the money is even better. Almost a 90% chance that 30 days later, that call spread would still be out of the money. So I thought that was pretty interesting, and this is what I'm going to be looking to do. And I'm going to sum up the conditions here in a minute. So don't worry about taking notes. It's all in the presentation. So the other situation is we want to sell bull put spreads when we're at the bottom part of the range. So to identify the bottom part of the range, I've already kind of looked through this, and I feel like the 200 is pretty good, but we can even change the moving average. This time, we want to sell a bull put spread that's below the moving average, and we would want it to be up. So let's go put this back to 1. So if we sold a bull put spread when we're trading below the 20-day moving average, you can see that a lot of the time it's actually up. If we change this to the 50, okay, 67%, not too bad. But if we do this on the 200, something interesting happens where you actually get a 75% chance during this time period that if you sold a bull put spread below the 200-day moving average on a 2-day sell-off, 75% of the time it stayed up or above that level. But again, we're selling credit spreads in which we can go farther out of the money. And I looked at this a little bit. If you sold a put spread that's about 5% out of the money, we would do 0.95 here, which means 5% below that close. Again, you get up into the 85 or the 85th percentile of the market staying above that level or above that credit spread. So again, we're using the same entry point. It's a 2-day sell-off. If it's below the moving average, the 200-day moving average, and we sold an out-of-the-money put spread, 30 days later, it's going to be up 85% of the time, or at least it was up during this time frame. So we're going to have to keep an eye on the market to see if this starts to, if we do hit that large range. Now, the question might be, well, what do you do if you get a 2-day sell-off and you're not above the 20 or you're not below the 200? And the short answer is you don't have to do anything. We're just trying to find high probability trades during a potentially range-bound or volatile market. I personally would start doing some shorter term things, and we're not going to talk about that in this video, but this is more of a monthly credit spread. So again, you might sell a credit spread that's 30 to 40 days out and look to close it early, that kind of thing. And we'll talk about that in just a second. So again, we're looking at multi-day sell-offs. We use the 20 and 200-day moving averages, and we have our spreadsheet. So let's real quick wrap up the bear call spread guidelines. So again, the trade entry is on SPY or SPX, and this actually did pretty well on the NASDAQ and Russell, but we're kind of looking at the SPY. The entry is the SPY or SPX closes down 2 days in a row. If the close is above the 20 simple moving average, 20-day moving average, sell a bear call spread with 40 to 50 days to expiration, where the short strike is 3 to 4% out of the money. And that's kind of what we just looked at. We saw that was in the 80 something percentile of staying out of the money 30 days later. Now, if you're adept with credit spreads already, you understand that if you can hang on to a credit spread and it stays out of the money 30 days later, you're going to be able to collect partial profit. So if you get a big drop, I would try to close the trade and collect 50% of that credit. Meaning, if you sold a credit spread for $1 and you get a nice little pullback and you can buy it back for 50 cents, that would be 50% of the credit. Now, if for some reason the market starts to rally to new highs and it's really going against you, you might have to do some defensive maneuvering with, rolling the spread out, or maybe selling a put spread and getting credit and rolling it higher, that type of thing. And that kind of falls into adjustments. We're not going to talk about adjustments later, but if the probabilities are there, you shouldn't have to do this too often. Again, we're speculating that the market's going to trade in this large range. So we'll wrap up the bull put spread guidelines. Same thing. If the SPY closes down 2 days in a row, is our entry. If the close is below the 200 SMA, sell a bull put spread with 40 to 50 days to expiration, where the short strike is 5 to 6% out of the money. So you might ask, well, how come with puts it's farther out of the money than with calls? And that's just how options work. Fear is always more expensive. You're always going to be farther away from the money when you're selling put spreads versus call spreads. And a lot of the reason is that stocks take the elevator down, they say, where it can go really fast against you. So there's more fear, there's more to sell, more premium in the puts. That's why you can sell something about 5 to 6% out of the money and get the same credit by selling a 3% out of the money call spread. So again, when the market closes down 2 days in a row and you're trading below the 200 SMA, you can sell a spread 40 to 50 days out with the idea that it's probably going to stay out of the money over the next few weeks, and you can try to buy it back for 50% of that credit. So again, also, if it starts to go against you, you could look to roll the spread out farther in time. And there's a lot of position sizing things that you can do with that as well. But again, I just wanted to give you a general guideline of what I'm expecting after this decline, a large range, and how I'm looking to play some of those monthly credit spreads. And that's really all I got. So again, if you want the spreadsheet or this presentation, check the description and be sure to subscribe to the channel as we continue to watch the market, and we'll trade together. All right. Thanks a lot, and I'll talk to you later.